Good afternoon, everyone, and welcome to our webinar this afternoon, What's New, What's Changing, and What's Staying the Same. Today's presenters are Karen Poist and Kimberly Tarnakow. And before I pass it off to them, as always, I have a few housekeeping items to go over. You can customize what you're seeing on the screen by going to the GoToWebinar screen viewer. You can maximize the webcams to feel like you're across the table from Kim and Karen, or you can maximize the presentation, whichever you prefer. We do have two different audio options this afternoon, the computer audio and the phone call option. We do find that the phone call option is a tad bit more reliable as it is not streamed over internet, so should you have any issues there, please try toggling back and forth between those two. We do have the handout that the ladies will be walking through this afternoon in the handout section available for download. So go ahead and grab that, or it'll be in our follow-up email that you will receive after the presentation. Any questions that you have, drop them into the questions panel of the GoToWebinar viewer. We do not monitor the chat box throughout the presentation, so if you have any questions for them, drop them into there. We will be offering CPE credit for this presentation, so make sure you're answering all three polling questions that are in the presentation today to be eligible for that CPE credit. Speaking of CPE, we do use a third party called SimpleCert to distribute these certificates. So if you're not seeing that drop into your regular inbox within a couple business days, check your junk and your spam folder, as sometimes it likes to slide into there. And if not, reach out to us and we will mitigate that as quickly as possible. And last but not least, our survey. We do take all of the valuable information that you fill out on the survey to, back to the tables to create more presentations that you as, attendees of our presentations will enjoy. So without further ado, Karen, Kim, take it away.
Thank you so much, Kaylee, and good afternoon, everyone. Today, we're going to talk about some things that are on everybody's mind in regards to, the expiring provisions under TCJA and what that looks like on the state front. But first of all, we're going to go and give you some background information of, how the states work in regards to the Internal Revenue Code. We're going to talk about what's some new things happening on the state front, what's changing, what's staying the same, and then of course we're going to wrap it up with our SALT reminders, remedies, and recent developments. So with that, we're going to move into state conformity. And again, just want to give you a little bit of background information about how this works. As we all know, and this may be repetitive for some of you, but just bear with us in this introductory piece. But states do incorporate provisions of the federal Internal Revenue Code, but generally they have their own approach and apply the federal code, at different levels. Now, basically, most states use and generally use their own state tax rates, but that's really, what does the state do when they see this federal tax code, and how do they apply that to their state's codes? Well, one thing we wanted to mention is that with state conformity to the federal Internal Revenue Code, there are a lot of benefits to conforming. And I think you, as whether you're a tax practitioner or you do planning, or you work with the taxes internally, or you've talked and met with your CPA and had some of these discussions, but you can see that the more that a state conforms to the Internal Revenue Code, the easier the compliance is. Because whatever you do on the federal side of things, predominantly it's going to be the same thing on the state side of things. Also, if you're going under any type of audit, or you have any type of questionable items on whether you can take a deduction or not a deduction, you have that reliance on certain federal statutes. You have that federal precedence, especially if you're following the federal code. And then also, hopefully it alleviates any type of double taxation. But as you can see here, there are a lot of benefits when a state does conform to the Internal Revenue Code. And so, why are we talking about this? One of the reasons we're going to be talking about this is because, everybody looks at the federal aspects of, what's my tax liability? What's my tax liability on the federal front? And that's great and all. But you'd never want to forget the state side of things, because what it could be for the Fed, and then you close up your planning books and everything, you go out there, you prepare your business returns, and all of a sudden, how do I have such a huge state tax liability? I wasn't even thinking of this, especially if you're working in multiple states or crossing state lines to do business. And that's why it's really important that we look at this and what can happen. So on one aspect, for federal purposes, you get the benefit of maybe a lot of deductions, but on the state side, you may not get those same deductions. So while you may have no taxable income on the federal side, you could have a large predominant amount of taxable income on the state side. So that's the importance of this, and that's what we want to talk about today. So with that, states use different approaches to conform with the Internal Revenue Code. Of course, it's the base for most states is the Internal Revenue Code. The first is the rolling conformity, and that's really the easiest. That's really where a state is kind of like, as we mentioned here, on autopilot. It just automatically follows the federal Internal Revenue Code. Whatever the feds put out, the states are going to follow. Now, those states also have the option to, pass legislation to say, yeah, I know the Fed has bonus depreciation, but you know what? We don't really want that. So although they may be rolling conformity states and pretty much are on autopilot and follow federal code, they do have those options to decouple, which means not follow the federal code and come up with their own ideas of how they want to approach certain things. The other is fixed or static conformity. And that's the adoption of the Internal Revenue Code at a specific point in time. And that's really important to understand because, as you're going to see on the next slide, there's a couple states that conform to the Internal Revenue Code prior to TCJA, which was passed and effective in 2018. So it's very interesting what these states do, but those states also pass some other types of legislation that maybe incorporate some of the new provisions going forward or may not even address them. The last is selective conformity, and that's where these states just incorporate just a few, not all of them, but only a certain few of those provisions. And there's a very limited amount of those states, as you can see here, as listed. And then obviously we have no corporate income tax in the listed states there. So with that, we're going to look at what those fixed or static conformity states are. So you can see here, these are some of those states. And as you can see, where the states have adopted the Internal Revenue Code. And we've highlighted California and Texas because it's very interesting. As you can see, both of those have not adopted the Internal Revenue Code since California 2015. So they haven't implemented anything with TCJA. Now, they may have passed some legislation on certain aspects of TCJA, but not all of them. And again, I just want to mention, for purposes of this, it's extremely important because understanding how these states work and understanding that you can't just assume federal taxable income is going to be your state taxable income, and that's how you compute what you owe to the states. You can get a handful of trouble there. But we just kind of want to give you that background information as to the lead up for some of the changes and nuances you're going to see across the board in today's presentation. So with that, let's move on to our first polling question, Kaylee. And you may not know this or not, and if you do, great. If you don't, not a big deal, but we just wanted to throw that out there. Is your state a rolling, fixed static, a selective, or you don't know what type of state that your business operates in? Now, you may operate in multiple states, but just pick your home state if you do operate in multiple states and let us know. So Kaylee?
Alrighty, so the poll is open. We have about 76% of the crowd has voted thus far. I will wait until about 80% or 85% participation, or if a minute elapses, whichever comes first. And it looks like everybody's sticking with us this afternoon, as already 83% have voted. So I'll give you a few more seconds to cast your vote. And this is your first reminder that if you're looking for CPE for this presentation, to make sure you cast your vote. Alrighty, I'm going to go ahead and close and share the results. And an overwhelming 54% say they don't know. But right. Place is 18% at fixed or static, 15% say selective, and 12% say rolling.
Yeah, and that was the purpose of this. We had an inkling that most folks do not realize that, the state impact with the federal tax code. So very good. With that, we're gonna move on to what's new. And Kim, you want to take it away?
Yeah, sorry, I had to unmute myself. Okay, so we're going to start with what's new, as Karen said. And the first thing we want to talk about is Section 174, which has to do with the deductibility of R&D expenses. Now, this is unrelated to the R&D credit. So whether or not you take the R&D credit, this can still apply to you if you have deemed R&D expenses. So when the TCJA Act passed, which was effective in 2018, there was a provision in there that said in 2022, starting in 2022, all of these 174 expenses, which are your R&D expenses, instead of being currently deductible as it has been in the past, you have to capitalize those and then amortize them over 5 years. For a lot of companies, a lot of A&E firms, this was a significant hit. I mean, the fact that now, because they have millions of dollars of expenses yearly for R&D, those are now not currently deductible. So this has been a problem. And again, they're still debating it. They're still trying to get some legislation passed before the extended due date of the return, retroactive to the beginning of the year for 2022. But we're not going to talk about that. What we want to talk about is the state conformity to that. With most of the states, they follow the Fed on this, which means the expenses would have to be capitalized and amortized for Fed as well, or for state as well. There are a few states, however, that are either have decoupled. For example, in our rolling conformity state group, we have Tennessee, which says, you know what, we're not going to do that. You can deduct all your expenses like you have been. And for PA, they did it for individuals only, which I guess is if you own a flow-through entity. But if you have a corporate entity, then you have to capitalize and amortize. For our fixed state conformity states, Georgia and Indiana have chosen to decouple, which is great. And as Karen mentioned, California and Texas are lagging behind with their fixed date conformity date, the adoption date. And for right now, neither of them are conforming to TCJA, which means that for California, your expenses are still currently deductible. So that's always interesting. Nothing like having to deal with all the federal changes and keep track of what the states are deciding to follow or not. The other thing that we've been talking about extensively for the last few years, the pass-through entity election, and with the SALT cap, which if you're not familiar with that is for an individual, if you itemize the most state and local tax deduction that you can take as an itemized deduction is limited to $10,000. As you all know, you hit that in half a heartbeat. So most people are losing a lot of deductions. Well, states have gone through and come up with the SALT cap workarounds is what they're referred to. And you can elect in certain states to treat the flow-through entity as a taxable entity that doesn't flow through to the individual at the state level. Then the taxes are deductible, the state taxes at the entity level, thereby working around the SALT cap. Well, you can see on this list the number of states that are new, either for 2022 or 23. On the next slide, we have a map, which gives you sort of a quick overview. And you can see that the blue states, 36 states, have enacted pass-through entity elections. The gray means there's no individual income tax, so it really doesn't apply. The yellowish ones are proposed, which is Maine, Vermont, and Pennsylvania. And the white states, DC, Delaware, and North Dakota, have not done anything. So we're not sure what they're waiting on. But anyway, so that's the current status of the PTE election and options available. Now we're going to run through.
Kim, real quick there. Yeah, those white are those are because they do not recognize pass-through entities generally. DC, I know, is a franchise tax or a corporate income tax only. So those could be some of those reasonings. But yes, carry on.
Okay, carrying on. So we're going to talk about some rate changes that are coming, and some of them are pretty significant. You know, this morning, Karen and I were discussing, because we get a lot of stuff comes through our email in the morning, and one of the things we discussed was New Jersey just said that their revenue for May of 2023 is 20% less than their revenue of May 2022. But we're seeing that in a lot of states. So state revenues are decreasing. However, many states have enacted rate reductions. Two of the most significant ones, and we've listed a bunch of them here on the next couple of slides. Pennsylvania is decreasing 4% over the next 8 years, which is very significant. Another one is Iowa, which is decreasing 4.3%, and that's a phase-in as well. So again, you can just sort of look through these and see where, if you file in any of the states, so some good news on the horizon. Some of them are only 0.3%, 0.5%, which you're really not going to feel too much, but we'll take any rate reductions we can get. So once we get past that, the next part is beyond the new stuff, beyond the rate changes. So Karen is going to take over with that, with some changes to Oklahoma.
Yeah, thank you, Kim. And note that these are, some of the corporate rates that we're referring to. And again, you're going to see rate cuts, corporate rate cuts, and individual tax rates. We're not delving into the individual aspect currently, but there are going to be rate cuts across the board on the corporate side of things, as well as the individual side of things at the state level. So keep that in mind. If you're a practitioner or you're working internally for your company and looking at those and assisting shareholders, things like that, that those are there. But what's really interesting about what's new is we've had bonus around since 2018. And now all of a sudden we have these states that want to just finally jump on board. So Oklahoma, they're going to do the permanent 100% bonus depreciation. They follow TCJA and they were 100% bonus before. It's good news for anyone operating in Oklahoma. So as it's going to be tough to keep up with, but as the federal goes down to 80% in 2023, Oklahoma is going to stay at 100%. When the federal goes down to 60% in 2024, Oklahoma is going to stay at 100%. So therefore, you're going to get that benefit on Oklahoma going forward, where you could be losing that, where you're going to be losing that currently on the federal side. Also, Pennsylvania is coming out something called new super depreciation. Effective 1/1/23. I don't want to get into the workings of this, but basically, you're going to have to add back the 80% in 23. Just like the federal, but they're going to give you some of these additional deductions along with that. But yes, Pennsylvania is implementing a new super depreciation initiative effective 1/1/23. So beware of that and make sure you can take advantage of that. Tennessee, again, this is another state that they're jumping on the bandwagon finally for bonus depreciation, but coincidentally, they're going to follow TCJA and the federal rules and phasing it out over the next few years. So yes, Tennessee, before you had to add back it all prior to 2023, as of 1/1/23, you're going to be following the federal depreciation going forward. Also, Tennessee has adopted a single sales factor. That's going to be implemented over a 3-year period, and it's going to be effective for tax years ending after 23. As you know, sales revenue, single sales factor, generally when you determine your state taxable income or a portion taxable income, you use 3 factors: payroll, property, and sales. A majority of states are moving to the single sales, which generally results in higher tax for the state, but that will be coming along the path. Tennessee has also incorporated some other benefits for business owners there in Tennessee. They do have a excise tax computation, but they're going to give you $50,000 standard deduction beginning for tax years after 24. So therefore, you can reduce that income subject to excise tax by that $50,000 standard deduction. Currently, I believe there is not one currently. And also the Tennessee franchise base, they're going to allow you to exclude up to $500,000 of real or tangible property when you're computing that franchise tax. So those are some beneficial things from Tennessee for business owners that are operating there. Idaho, again, single sales factor comes to mind. As I mentioned, many states are implementing the single sales factor. It's going to make it hopefully easier for practitioners, as well as your tax area folks internally that are doing planning and things like that, and determining what our potential liabilities could be on the state side of things. They're also moving from a cost of performance sourcing of services to market-based sourcing of revenue. And that's effective after 1/1/2022. So that's been in place this past year. Now, also, this is kind of an odd one here. Is this New Jersey automatic S-election with the federal S-election, and the effective date is just odd to me, which is 12/22/22. But prior to, if you were a corporation and you decided to do an S-election, there's certain states that did not follow the federal S election. You had to file a separate S election, or you remained a C corp for state purposes. New Jersey was one of those states. So if you didn't file a separate S election for New Jersey, then you remained a C corp while your federal was an S corporation. So again, they implemented this effective 12/22/22. So what happens is any entity that makes a federal S election after that date will automatically be an S corporation for New Jersey purposes, unless you check that opt-out provision and you want to remain a C corp. Okay, so currently, if you're a federal S corporation prior to 12/22/22 and you were a C corp for New Jersey, you would still have to make that S election, is my understanding. I don't believe it's an automatic change, but that's something, if you're considering that, is definitely to check the rules and guidance on that to make sure that you're following that correctly to get your proper result. And then just a few things here that I wanted to mention. You know, Colorado set up this delivery fee, delivering packages into Colorado. They charge you another special fee just to raise some from state revenue. Well, Minnesota just piggybacked on theirs and is implementing this effective next July, regarding, you know, transactions over a certain dollar threshold. And, you know, they do have a small business exemption here for any type of sellers that are under the $1 million threshold. So that's good news. So if you're a seller into the state of Minnesota and you don't do a lot of business there, hopefully this doesn't impact you as a small business owner there. But if it does, you know, be aware of this new rule, making sure that you're registering and filing, you know, and stay in compliance here. Now, also, Alabama has adopted a 40,000 ad valorem exemption. What this is a lot of the southern states still incorporate a personal property tax on a business owner's fixed assets, tangible property. And what they're doing now is they're going to give you a $40,000 exemption. So if you have property and equipment under $40,000, more than likely you're not going to have personal property tax. If you have more than $40,000 worth of property, of course, you're still going to be filing and paying that tax. Also, Alabama implemented and adopts a tax break for overtime pay. And what that is, they're going to exempt from income taxes beginning in 2024 any pay for overtime. So that's good news for those folks that work a whole lot of hours, that they're not going to be paying income taxes on that overtime pay. Not to say that you're not paying it on the federal side of things, but you will be doing that currently. But on the state side of things for Alabama, you're no longer going to have to pay tax on that. And Kim, I'm going to turn it over to you on these new Washington things.
Okay, we just got 2 quick updates on Washington. We've talked about this before. Washington has enacted a new state capital gains tax. It's at the individual level, not the corporate. But what's interesting is Washington doesn't have an individual income tax. Well, the state is taking the position that it's an excise tax, not an income tax, and they're sticking to their story. So it was effective in 1/1/22. The rate is 7%. On long-term capital gains over 250,000. If it's below 250, you don't have to pay. Now, it's gains on tangible personal property. That would be, their examples in the ruling were yachts, cars, planes, big ticket personal, not real estate. So to be subject to the tax, the property had to be located in Washington and sold by a Washington resident and not subject to capital gains in another state. So they're very specific, and they're all the 3 and tests, not an or, and. You had to have all of them. And for intangible property, that's stocks and bonds, the owner had to be domiciled in Washington. So just be aware of that if you're selling anything large that's tangible, personal property, or intangible property. Also, Washington, they passed a long-term care premium tax withholding requirement back in 2019. And due to some controversy, they sort of held off on enacting it. Well, it's here. It comes to roost on July 1st. So be aware that if you have employees in Washington that are subject to the paid family and medical leave tax, they're going to be subject to this other tax as well, the long-term care premium. Now, there are certain exemptions that are out there that maybe you can get for some employees. You can look into that. One thing that's odd is the total maximum benefit, which will be indexed for inflation, is only like $36,500 as of now. It's not a huge amount of money, not going to cover a lot of long-term care. And if you retire and move out of state, the benefit doesn't follow. It has to be used in Washington state. So I think that's about it. We're going to move on to our next polling question. Kaylee, if you want to go ahead and launch that. If your company is a pass-through entity, such as an S-Corp, LLC, or partnership, has it made any pass-through entity elections, either for 2022 or 23? Yes, no, maybe, or I'm really not sure, that's not my area.
All right, so the poll is distributed. It looks like 60% of the crowd has already voted. I will give you a few more moments here to cast your vote. And here's your second reminder that if you're looking for that CPE, to make sure that you're hitting all of these polling questions. All right, 78%, just need a few more people to cast their vote, and then I can turn it back to Karen and Kim. All righty, I'm gonna go ahead and close and share the results with everybody. And it looks like 43% don't know, 30% say yes, 23% say no, and 3% say maybe.
Well, that's great.
Yeah,
very good. We're going to have Karen start in our next area, which is what is changing.
Yes, and just to go back and reflect on what's new, there's a lot of new things coming across the states, and obviously it's not all inclusive. So we're trying to point out a lot of the highlights of things that are new currently, and just to be aware of. And the predominant ones, as in summary here, is really the rates, the corporate rates. If you're an S corp or a flow through entity as a partnership or an LLC, the use of the pass-through entity elections to your benefits. And then the bonus depreciation and where the states are incorporating some more beneficial treatment on that front. So, just in summary, just keep an eye on some of those new items that are coming across, but things are, again, always changing. So that leads me into what's changing. So those of you that have remote employees, or you have traveling employees, a couple states here are kind of jumping on that mobile workforce policy that's been out there. I think the legislation and Congress has been trying to pass some things for a number of years now to kind of simplify the rules. I don't think there's anything simple about any of this. But I think I advanced the slide real quick here, but I'm going to go back. But there's a number of states that did jump on this bandwagon and try to make it a little bit easier for folks traveling into their states, as well as, the first one here I want to point out here is Louisiana with their new digital nomad. Now, this came about, I think it's back during the COVID era or 2021, and they were trying to encourage folks to come to their state to work. And as you can see here, one of that big benefit is there's a 50% exemption of your wages if you live and work if you're a non-resident and you work in Louisiana from taxation. And I thought that was a pretty good pull for folks to come in. But then again, it's limited to 500 individuals. So first come, first serve. But that's in place between 2022 and 2025. But then the other ones are this the 25-day mobile workforce policy for Louisiana. Indiana adopts a 30-day. And basically what that means is that you have an employee that goes into that state, and that's great. They can be there for 25 days or 30 days before you, as an employer, are required to do any type of withholdings on that pay. Now, they're still considered that state's wages and reportable wages to that state, but you are not required as an employer to withhold state income taxes on that. So moving along here, we see Montana adopted one just recently as well, a 30-day mobile workforce. So hopefully we're moving away from that one-day rule where you're in our state for one day, such as Alabama, and you're subject to withholding on any wages earned in the state, to more of a reasonable. We'd like to see this get even better, but not sure if that will or not. But anyway, the states are going ahead and making their own move on this, which is a positive in itself. So we're going to continue to follow that. But if you do have folks traveling into those states, know that you have a 30-day grace period before you're required to do any type of withholding on that. And if you're not certain about other states, that's something that Kim and I can help and consult with you on, if you do have folks going into other states, traveling into other states, and what your requirements are from a payroll perspective. So we're seeing a lot on this franchise tax. It's one of those things that I think the states are done with. People would like for it to go away, and I think the states are complying in that fashion. So you can see here, Oklahoma franchise tax. It was in, it was out, it was in, and now it's going to end. It's going to end in July of 2023. So we're coming up on being done with that. So that's a good thing. Mississippi and Connecticut, both those states are phasing out their franchise taxes, and that's on a good note. And then currently right now, Louisiana's in this legislative session. It's proposed to phase out their franchise tax. So again, hopefully that's one less tax that business owners are going to have to pay going forward. Along with the rate reductions, the elimination of the franchise tax, and some other benefits that we're seeing, it's hopefully more proactive on the business side from the state perspective. With that, we also see what's changing currently with Connecticut. Connecticut was one of those first states that had that pass-through entity election that Kim was referring to with that SALT cap workaround. Well, Connecticut, when they implemented that, it was mandatory. You had to do it. You didn't have an option. But now they've come out and said, well, we're going to make that elective. So it's up to you now, the business owner, what you want to do. But it is going to be mandatory through 12/31/24, and then it's elective as of 1/1/25, which is interesting because as you can see on the next bullet, the state pass-through entity elections may be expiring. With the SALT cap workaround that was implemented through TCJA back in 2018, the limit to only allow $10,000 deduction, okay? A lot of these states, when they implemented this pass-through entity election and workaround, said that, well, if the SALT cap limit goes away, then so does our pass-through entity elections. They expire as well. So, you know, the thing is that you see all these states implementing all these pass-through elections. As Kim mentioned in the earlier slides, you got about a handful of states that are starting to put this in place. Why would they do that if this is all set to expire in 2025? Well, maybe give you 2 years of benefit, or maybe there's some other hidden underlying message here that means that that SALT cap limit is never going to go away. So even though it's set to expire, we're going to wait to see on that. We're going to talk about that later in the presentation. The other thing that we mentioned in what's new is this bonus depreciation. And for federal purposes, the bonus depreciation is expiring. It's phasing out beginning in 23 through the end of 26. And then it's completely phased out in 2027. But as I mentioned earlier, there's certain states that are jumping on the bandwagon now, such as Oklahoma. They're going to say, well, I don't care if the federal's going to phase it out, we're still going to give you 100%. Tennessee, well, we never gave it to you before, but we're going to jump on the bandwagon now and give you that phase out over the next few years. So it's very interesting on how the states come up with their rationales and what they do, but if it's beneficial to the business owner and taxpayers, so be it. So there's also some other various federal income tax laws that may be changing, and we've listed a few of those here, but we're not going to get into those. But just be reminded overall, in summary here, is that states can be impacted. Your state tax liability can be impacted positively or negatively with all these changes, depending on what's new and what's changing. So you may have owed something last year as a certain amount, but for 2023, it could be significantly different. And then in 2024, it could be even more different. So it's one of those things to make you aware of and understand that when you are, or your CPA or practitioner, or you going through planning or looking at the end results of for your tax liabilities, like what happened? Last year we didn't owe that. Well, there's reasons why you didn't owe it last year. Or you know, this year you might be getting a refund in 2023 versus owing last year. Well, what happened? We're all pretty much the same. We did the same thing. Well, it's because the tax laws changed. So just be aware of the changing things and the impacts it can have positively or negatively, you know, on your tax liabilities. So with that, we're going to move into another polling question. And Kaylee, do you anticipate your company will be impacted by the changing tax laws? Yes, well, very, somewhat, none, and you may not have any idea. Now, I know we mentioned a couple of the states that we talked about has some big changes, but you know, maybe this can help you with how you answer your question. So Kaylee, go ahead.
Alrighty, so the poll is launched. We already have about 80% participation, so I'll leave it open for a few more minutes here, or moments, I guess, and then go ahead and close and share. This is your third reminder to make sure you're doing these polling questions to be able to receive the CPE after the presentation, and about 50% are trending and saying some, so they anticipate that you know, they will be somewhat impacted by the changing tax laws. So I'm going to go ahead and close and share the results so everybody can see how their peers have voted. And so that's stuck right there at 52% say somewhat, 17% say very, 14% say none, and 18% say I have no idea.
Okay, well, very good, Kaylee. And Kim, I didn't know if you had anything you wanted to mention on changing tax laws, or before we move, you move into staying the same regarding some of that. But again, you know, as you can see, the burden to comply with the state rules versus the federal rules is very time consuming and costly. So with that, Kim, I'm going to hand it over to you again as to what's staying the same.
Thank you. So we're going to talk about section 163J, which is it's known as the business interest deduction limitation. So how this impacts us for state purposes is that most of the states conform to this provision in the federal code. So that's why we thought it'd be worth mentioning today. So it's staying the same, but with a twist, because it's been around since TCJA. And basically how this works is, in theory, you almost do an EBITDA calculation. So the earnings before your amortization, depreciation, depletion, except you're using taxable income. And so you get to add all those back, so it gives you a higher starting point. And you take that higher starting point times, for a while it was 50% of that. You couldn't have interest that exceeded 50% of that number. And now it's back down to 30%. But starting with this year, well, actually with 2022, then I talk about this year because we're still filing 22 returns. We're always a year behind. But starting with 2022, you have to now deduct the depreciation, amortization, and depletion. You don't get to add it back. So now your starting point is a whole lot lower, especially if you have a whole lot of assets in which you were taking bonus depreciation or you're amortizing a lot of things. So that is going to be limited at the federal level, and more than likely will flow through to the state level. And there are some states that have decoupled, just like with everything else. You know, there's some states that have chosen not to follow this, but it's just a handful. It's not very many. Now, there is a small business exception if you have 27 million average gross receipts for the last few years, and then you wouldn't be subject to it. But just so you know, it's up to 29 for 2023. But just be aware that that may be something that's going to affect your state tax liability that's starting at the federal level and sort of trickling its way down. The same with meals and entertainment expense. Well, actually, entertainment expense went away with TCJA, but for the meals expense, for a while we were allowed to take 100%, trying to encourage people to get back to the restaurants after the worst of the pandemic. Well, effective 1/1/23, we're back to 50%. So just be aware that that's going to be, if you're a business that has a lot of M&E deductions, then just be aware that it's going to be reduced this year. So again, increase your federal liability, increase your state liability. Then there's state and net operating losses, which generally the states, they don't really follow federal. There's a couple that piggyback off the federal NOL, but generally they have their own rules. You go through and calculate your state taxable loss that's generating the NOL. You have to consider your apportionment factors. But it just, they have their own rules. So most of them are staying the same, but just be aware that there's a few states that are proposing changes or have made changes. So Colorado, Indiana, a few others are updating the rules. Like some states you'll see only allow you to offset 70% of your current tax liability with NOLs or whatever. Just be aware, or there's a dollar threshold. So just be aware that just because you have state NOLs, they may or may not fully be utilized this year or next year. So just be aware. Okay, the next thing we're going to talk about are, so states are decoupling, and Karen's talked about several states that late to the party, but hey, better late than never. They've decided to jump in and start doing bonus, changing the depreciation calculations, which I'm pretty sure I can safely say that all these legislators who changed these rules have never prepared a business tax return and have had to keep track of depreciation at the state level, because it is a nightmare. And if they did that, they would just leave depreciation alone. They would pick on something else that's easier to track and manage. But just be aware that those are changing. Always an adventure with depreciation. Generally, I think the state codes are primarily staying the same. However, as we mentioned previously, a lot of the states are short on cash. You know, what do we do? How are they going to generate more money? They're looking towards unclaimed property. They're and some of them are reducing rates. So if they're reducing corporate rates, they've got to get the money somewhere else. So look for changes to be happening, because the states need the money. They need the money. So we're also going to move now into our SALT remedies, which basically we cover this every time. And just so you know, just if you find that you think you may have an issue filing in a state, or you haven't been filing and you realize, oh dear, I should have been, you know, I've been in the state 20 years, this could be a big problem. Just call us and talk to us. We can just sort of talk you through things. We can help quantify things, but there are remedies that are available. And we're not going to belabor these with the voluntary disclosure program, which usually waives the penalties, not the interest, and it limits the look back period. There are amnesty programs, which are usually isolated to specific taxes for a specific short period of time. And some people always like to go on the get caught program, which is, hey, if they catch me, then I'll start filing, which can be very costly, because they can go back a lot of years if you get caught. So just remember also, if you're looking, if there's anything in your future which looks like you may be selling your business, just be aware you need to get your house in order on the state and local side before you do that, because we've seen purchase prices reduced quite a bit by state issues, state and local issues. So just be aware and know that there are remedies out there. And then every time we sort of give you our state tax consideration, this is just our laundry list of, hey, you know what, read over this and read over it quarterly every time we have our SALT webinar. And just sort of see if maybe anything jumps to you. Oh, I didn't look at that. We're in a new state. Do they have a personal property filing? Oh, what about unclaimed property? You know, just this is sort of a trigger to help trigger things in your mind that you need to look at. So from that, we're going to move on to the SALT recent developments, which there have been a whole lot of activity. So buckle up.
Yeah. Thanks, Kim. And again, just to reiterate what Kim said, is a lot of these SALT reminders is just things that are ongoing with your company, your business operation. Is just making sure that you have these things in place. And you know, if you have questions or uncertain about something, you know, consult with your CPA, or feel free to reach out to Kim or I to assist you in, you know, what do I need to know about this, or I need to know some additional things on something. But it's best to, you know, making you aware of these and then acting upon them if you feel that there's some type of, you know, off, you know, with your company and that you need to get back on track. So again, this is a great, like Kim mentioned, laundry list as a reminder just to go through, whether you do it at the end of the year, if you do it at the beginning of the year, during the course of the year, but it's something that you should pay attention to. Again, new remote employees, have we covered our basis on that? Did the sourcing of sales revenue change in a state? Again, these things are always changing. New things come out. Different things happen, so you know, it's just to keep an eyeball on all of that. So with that, I'm going to move into SALT recent developments. And one of those things you probably keep hearing in the news is higher taxes on high earners. Well, you know, a handful of states are looking at that, but Is it really going to happen or not? Who knows? But it's something that's out there. It's being talked about, and that's why we listed it here. Also, we noted that there was a bill introduced to continue the qualified business income tax deduction. That's a 20% deduction for S corps, partnerships, LLCs that is able to be taken on the individual return. It was a very attractive deduction that people have been taking advantage of through the TCJA. Unfortunately, that's set to expire in 2025. So a bill was introduced to continue that. Now, whether that happens or not, it's under the main, I think the Main Street Tax Certainty Act. It was put in through, that bill was put in through. So who knows what'll happen on that. But again, that's a recent development that's occurring now. Hopefully, maybe something will happen on that front, and we can continue to derive the benefit of that deduction. Also, another big topic of discussion is this continued talk about the SALT cap limitation, which is a huge issue for those high property tax states such as New York, New Jersey, California, where they don't like this at all. And they're looking, there's some talks about looking to raise it to 60,000. But what we've seen, and I'm going to talk about the new GOP tax package that came through recently, but included in that package, there was no talk about this, assault provision. Whether it was going to expire, or if they're looking to raise it, or what they're going to do. There was no mention of it. They thought there would be something in the debt limit talks and the passage of that a few weeks ago. Nothing there. So nothing has happened on this, and a lot of people are not happy about that, and are not looking to pass the beneficial GOP tax package that's out there currently that we're going to talk about now. And that is called the American Families and Jobs Act. And that is the GOP proposed tax package, and it incorporates three bills, okay? Build It in America Act. It's Build It in America Act, the Small Business Jobs Act, and the Tax Cuts for Working Families Act. And I think that they divvied these up into these various acts because they're hoping to get some passed, maybe not all of it. But anyway, as you can see here, the Build It in America Act is to reinstate and extend the 100% bonus depreciation. So, that's currently under TCJA, that's looking at being phased out through 2026. But what we're looking at now is that, under this, American Families and Jobs Act and the Build It in America Act, they're looking to extend that. So that's good news for business owners. They also want to delay the mandatory capitalization and restore the research expenditure deduction under Section 174, and they want to make that retroactive back to 1/1/2022. So that's another positive for these professional firms that do a lot of research and development, and being able to continue to take that deduction. So although if you've filed your 2022 return and you've capitalized those costs, if this bill does get passed, hopefully you can go back to 2022 and amend that return and recoup those tax dollars that you previously paid and get those back. So again, the Build It in America Act is really beneficial to a lot of taxpayers. Now, under the Inflation Act, they had set up all these clean energy tax credits, but in the Build It America Act, they're looking to repeal the benefits of getting those energy tax credits. And I think it's just a compensation difference between the first few bullets and this bullet. They got to take out something, but they got to meaning they want to put some other things back in place. Also is reinstate the allowance for depreciation and amortization. Kim talked about 163J, the interest expense limitation, and using a higher starting point. And they want to put depreciation and amortization back in there, so you start with a lower point when you're looking to limit interest. And again, they're going to make that retroactive back to 1/1/23, and there's some elections that you can go back to 2022 on that. But again, that's part of the Build It in America Act. Now, the Small Business Jobs Act is another piece of this proposed tax package, which what this does for business owners, it gives them an additional Section 179 deduction up to makes it up to $2.5 million, which is really good for, again, business owners, and investment into companies with property and equipment. Also, maybe a little less burdensome when you're filing your 1099 reporting, is raising that $600 measly threshold to $5,000 for general 1099 reporting, beginning in 2024. You know, as things go, there's a lot of $600 thresholds out there for that 1099 reporting that are a nuisance, and raising that to $5,000 for general 1099 reporting looks very attractive for the compliance aspect at the end of the year. Also, raising that 600 threshold to 20,000 and 200 transactions for the 1099K reporting, beginning in 2024. Again, that's to ease the burden for compliance matters, and hopefully, you know, some of these will make it through. The last item, and I think the most attractive to a lot of people, and maybe it hits home with a lot of folks, is this under the federal side of things, is the increase, the current standard deduction. You know, $4,000 for married filing jointly, $3,000 for head of household, and $2,000 for single. But it's only for 2 years, 24 through 2025. But you know, still, it would be nice to get that little additional deductions for everybody when they go to file their individual returns. It's kind of a nice little piece that's in there, and that's under the Tax Cuts for Working Families Act. So again, there's a lot. But Kim, with that, I didn't know if you had any other comments to add on that GOP tax package that's being proposed or not, or any commentary there. But the last thing that I can say on that is, you know, again, what will the states do on the business side of some of those things? What will the states do on those, and how will they react to those? So anyway, Kim, if no comments, or add your comments, and we can move on to recent developments in unclaimed property. Did we lose Kim? Well, we may have lost her.
I have to unmute myself, sorry.
Okay.
Those packages, or the package with the 3 bills, has some incredible provisions in them, and I really hope that we can get some of it passed at least, because it would really help us general taxpayers who, you know, just to be able to survive with all the inflation and everything that's going on in this crazy world. So we want to talk about unclaimed property just a little bit, and it's just a few reminders that Illinois has decided that they have mandatory filing now for reports of companies that are incorporated in Illinois, have locations in Illinois, or carry business permits in Illinois, if any of the following apply. So if you have an Illinois location, you're organized there, or you have any permits there or specialty licenses, be aware that the state may be looking for an unclaimed property report for you. If you have sales of more than $1 million, which is sort of a low bar, securities that are publicly traded, net worth of 10 million or higher, or more than 100 employees. I think the one that's going to catch most people is annual sales of more than $1 million. So just be aware. They're not messing around with unclaimed property. They've sort of putzed around with it all the states for a lot of years, and they're getting serious about it. Karen and I are just wrapping up a Delaware unclaimed property. It's called a self-audit. It's where the company received the invitation to participate. If you don't accept the invitation to participate, then you will be, you know, full on audited. And it's basically taken 3 years to wrap it up from the date they received the original letter. So just be aware, you need to be mindful of unclaimed property and pay attention. And so the other states that are sort of active are California, which, you know, they've got that question on the tax return now. They're asking you about it. They've got a VDA, a program that's in place. Delaware, Minnesota, New York, they're all currently getting real active in this unclaimed property. And again, I feel it's to raise money, because if they start doing extrapolation, if you don't have records 15 years back, then chances are they're going to be extrapolating, which means it's just straight up revenue to the state. So anyway, just be aware.
Yeah, and Kim, before we move on to the next slide, one thing on this unclaimed property, if you're not familiar with unclaimed property, you know, feel free to reach out to Kim or I if that's not something that a term or something that you're familiar with, and we're more than happy to go over that and explain that to you. It's not technically a tax, but it is something that can be very detrimental if it's not filed. And as Kim mentioned, you know, handling audits under this, there's no, what is it, statutory limitation as to how far a state can go back to retrieve. And, you know, so this is something that, you know, I think the states look at this as an easy way to gather some income. And it can be very detrimental to the company if you're not complying in this aspect. So.
And the one I referred to that we were just wrapping up, it started really in 2020. So that was like the last year covered on the VDA period, but they had to have records back to 2005, and I mean detailed records. And so, you know, I don't know how many companies have those, but anyway, just be aware, you really need to get ahead of that. So I guess we're ready to move on to our favorite time of our SALT webinar, which has to do with the map. So it's a little bit fuzzy, but we're looking at favorite burgers by state. And so you sort of have to maybe look at the logos or the name to sort of tell on some of them because they're small, but the predominant ones are Five Guys, In-N-Out Burger, Whataburger, Burger King, and I think there's a couple other ones, Culver's maybe. But anyway, so take a look at that. You can sort of see, and then we're going to get to our next polling question.
Our last
on there too. It looks like
polling question.
Our last polling question.
Yeah.
Our polling question.
Yeah.
And this is very, very important and critical that you get correct. What is your favorite burger? Because we all have our opinions.
All righty.
And it may not be listed.
The poll's out there, and you have quite a few options here. So you have Five Guys, In-N-Out, Whataburger, and your last answer is Burger King, Culver's, or other. And if you're answering other, I'm kind of curious what your other option is.
Put that in the comment section.
All righty, so we have about 82% that have participated. And ladies, I think this was the quickest poll that we have our threshold for. So everybody's just as excited as you are about this one. So I'm going to go ahead and close and share the results. And I don't know, 41% say Five Guys, 20% say In-N-Out, 9% say Whataburger, and 30% say Burger King, Culver's, or other. And some other options that are coming in, Shake Shack, Liberty Burger. Those are some good options. Those are some good options there. Well, any final remarks, ladies?
Yeah, I just like to say there's nothing better than a great burger in the summertime, right? And I'm surprised somebody didn't say, you know, the burger that I cook on my grill outside, right? I mean, those have to be good too. But anyway, we greatly appreciate you all joining us today. Hopefully you're able to take away some good information. And again, as always, if you have any questions or need clarification on anything, you know, please feel free to reach out to Kim and I, or put your questions in your comment sections of the surveys, and anything or something that we may not have covered that you would like us to for future webinars. So Kim, anything you'd like to add?
I would say that I totally agree with those poll results. I think Five Guys burgers are pretty fabulous, but the fries are a little greasy, but they're good. They're just greasy, but always a good choice. Can't go wrong with burgers in the summer.
No, not at all. So, well, thank you all again. We appreciate you attending and look forward to seeing you at our next webinar, hopefully in September. So take care and have a great rest of your day. Thank you.
Bye.